Listen, the market acts just like a human being. They may seem random and overwhelming at the first sight, but most of the time, you can actually predict it based on their values, feelings, and urgency. True story. But here is the real question. If it's that simple, how come so many investors still fail trying to predict the market and lose their money in the process? It's not that they're using a wrong or outdated strategies. Actually, most of the right investment using a basic calculation. But there's something fundamentally missing with their approach, which we're going to talk about later. In my mind, I know I was missing on something if I'm not learned about this sooner. So I went full into the rabbit hole. In 1994, a hedge fund called Long-Term Capital Management was built around a simple trade by economy experts and legendary investors. What they do is basically find two similar securities that should trade closer together. Buy the cheap one, sell the expensive one, and wait for the spread to converge. Yeah, they did that across sovereign bonds, corporate credit, mortgage-backed paper, and treasury relative value trades. But the problem is, those spreads are small, so to make the returns meaningful, they had to scale. By early 1998, LTCM had about $5 billion of equity and had borrowed well over $100 billion. For 4 straight years of crushing it, the double-digit returns every year. But then, in August 1998, Russia devalued the ruble and stopped payments on its government debt. The crisis spread globally. Investors everywhere panicked and pulled back from risk. You see, when investors get scared, they stop thinking about big profits. Instead, they just want to move their money to somewhere safe and easy to sell quickly. Think of it like a fire drill where everyone rushes to the nearest exit at the same time. Here's the part where everything fall into pieces. Investors flooded into U.S. government bonds, specifically the newest ones, because those are the easiest to buy and sell fast. So, the older bonds became less popular and dropped in value compared to the new ones. And then, the price gap between them grew bigger and bigger instead of closing. LTCM had bet that this price gap would shrink because bros think those bonds are almost the same. And when the opposite happened, they lost an enormous amount of money. All right, think of it like this. Imagine you borrowed $29 from your friends to buy $30 worth of stuff using only $1 of your own money. If that stuff loses just 5% of its value, you've lost $1.50. That's more than everything you started with. You're now in debt, and all your friends want their money back immediately. So, you have to sell, even if you believe prices will recover tomorrow. That's exactly what happened to LTCM. When you borrow a huge amount of money to invest, price drops aren't just losses on paper, they trigger your lenders to demand immediate cash. So you're forced to sell, even at terrible prices. And selling into a panic market makes prices drop even further, which causes more margin calls, which forces more selling. It's a loop that feeds itself and gets worse with every cycle. What made LTCM's situation even more dangerous is that they were not the only one. Many other funds had the exact same trades, built on the same models. And when the crisis hit, they all needed to sell at the same time. Nobody was left to buy. Prices dropped. In the end, LTCMs had $100 billion in exposure with only $600 million as a cushion. Essentially, no protection left. Bros have lost so much money so fast that the Federal Reserve had to step in, not to save LTCMs, but to prevent a chain reaction that would have hit every major bank simultaneously and potentially collapsed global markets. 14 banks were organized to inject $3.6 billion into LTCM to slowly wind down the fund in an orderly way. LTCM's just lost 44% of its value in a single month. End of the story. It's funny that their math was still correct on paper. Those bonds really were similar, and the price gap really should have closed. But being right doesn't matter if you run out of money before the market proves you right. I think LTCM was relying too much on their leverage, also known as borrowed money, to make meaningful profit efficiently. So they put all their eggs in one basket. Big mistake. It is crucial to not put yourself on the edge of a cliff where a single decision could destroy your empire, just one unexpected crisis away from failure. The reality is, it was long-term capital gain all along. What an irony! That brings us to the next mistake, using prediction and calculation alone to win the game. Think of it like this. Predicting the market is like making a strategy for a football game. Making money is not about the strategy itself. It's winning the game. You might have a head start from learning about your opponent's movement, pattern, and behavior. But to win the game, you must score. To do that, you have to condition your players, like their emotional and physical state. What is going to trigger them and affect their state badly? Like I said before, the market acts just like a human being. It has emotion, sensitivity, and priorities. From this experience, it's important for you to have a substitute player. If your best player gets injured, you can still continue the game. In your case, you need an emergency fund, at least enough to support your basic survival and start over once a crisis hits. But I want you to remember this one important detail from this video. Even if you're doing everything right, you might still lose your investment. But that's not the point, because one single investment doesn't make up your career. You need multiple wins to become a champion, and probably a few losses. The real prestige isn't about predicting the next move. It's building something so stable that you can be wrong and still be okay. If you're live on one economy crisis away that could have made or destroy your investments in a single strike, that's not an investment. That's called gambling. That's why most people fail, because they lack patience. I hope you learned something from this video as much as I did. If you found this video valuable, please consider subscribing and joining the community. Every video is built around the questions that actually matter for capital allocation, not the noise.